And for more, we're joined by Daryl Ho, Senior Investment Strategist at DBS Bank. So, Daryl, interesting this report. What stood out to me was a line that you guys included. It was a famous quote, of course. It was the best of times and the worst of times. Why was this line included in the report?
I think this line is, we're quoting Charles Dickens, obviously, and it's kind of suggesting the environment that we're in. You know, the best of times kind of signifies that this is a really ripe opportunity for investing, because if you look at the AI boom, it's led to an earnings cycle that has been really, really strong. So just to give you some context, you know, in 2025, the returns on the market, a good 87% of it was from earnings growth and not so much from multiple expansion. So it's not a speculative type of return. And so investors cannot miss out, you know, exposure to equities because of this reason. But on the other hand, it's the worst of times because, you know, the post-war American-led global order, you know, which is a rules-based order, is undermined by seemingly America itself. And so we have to also be used to geopolitical uncertainty. And so if you marry these two together, you know, sometimes investors kind of like, which one do I choose? But, you know, at DBS, we prefer to, you know, have a barbell approach where you have exposure to both. You know, don't miss out on equities, right? Hold on to exposure in equities because we are in the midst of a very strong earnings cycle. But on the other hand, you know, you also have high quality bonds, for example, to give you income. You know, gold as a geopolitical hedge, because this is kind of like the flavor of the day.
Yeah.
And also alternatives, which gives you non-correlated returns. And so when you have these both in your portfolio, you know, shocks like this, like the conflict, you know, you can rest easy because your portfolio has a natural hedge.
Yeah, it's hard to look past the noise, especially with the headlines coming. The way we see oil has been moving the past few weeks. In fact, since start of the month, it's up 40% already. How significant is this Iran war compared to past Middle East conflicts? I know that your report calls it a war of choice, says there's no explanation of strategic intent. And your worst case scenario for this is oil hitting at $150 a barrel. And I also note that you say that, you know, a full blockade, while extreme, has a low probability of happening then. But then what other sort of disruptions could actually keep volatility elevated?
Yeah, so, you know, we describe this as a war of choice because I think the perception is this could have been avoidable. But if you think about human nature, you know, it may have been a little bit more obvious from the start. You know, if you think about Donald Trump's presidency, this is his second term. Yeah. And we're approaching the second half of his second term. And if you look at the prediction markets today, the odds of Democrats taking the House is actually quite high. So from a perception standpoint as a president, he might view this year as perhaps the final year that he could push through legacy-defining changes in his presidency while he has control of the Senate, the House, and the presidency, right? And so I think we have been cautioning investors that this year could be a year of volatility. So we're not completely surprised by the conflict. That said, you know, we did say the worst case scenario was that oil could be 150.
Yeah.
We think that is, you know, a worst case. You know, the base bear case is still $80 to $85 a barrel. And why I say that is because, you know, it's also not in the interest of Iran to have oil prices so perpetually high for so long.
Okay.
Right? They've already changed a bit of the tune. While they did initially say that there could be a blockade for a while, they decided to do their own version of tackle, you know, where they turned it around a bit and said that, you know, perhaps we'll let most vessels through except the US or Israeli vessels.
Yeah. And at the same time, I mean, that we're dealing with this oil conflict, this Iran conflict, the report also says that we're actually seeing a once-in-a-lifetime kind of digital transformation that is driven by AI. I don't know how powerful is that as a tailwind for global growth? And then especially in this region, you know, we're talking about Asia being hit harder in this particular crisis, given the reliance on Middle East oil. But Asia is also at the forefront of AI. You've got your South Korea, Japan. You know, how much of an impact is this expected to have?
Yeah, great question. You know, so you know, Asia to date, I think is still one of the better performing markets. If you look across the spectrum of risk assets around the world, Asian has been quite stable. Asian assets have been quite stable. And so, you know, we continue to think that Asia, with its less demanding valuations, continue to attract that tailwind of inflows, especially with the narrative last year carrying over that investors are seeking, you know, assets outside the US to invest in for diversification. Nonetheless, you know, we are a little bit more sanguine about the outcome because if you look at the data from the year 2000 onwards, the energy dependence of Asian countries on oil has actually declined some 30%. And so, I think Asia has taken steps, to extricate themselves from that reliance on crude, given, the very significant risk that can emerge from conflict. And I think, diversification towards renewable supply chains, as you've seen in China, as well as nuclear energy, which is a big topic nowadays. There are progressive steps that have been taken to remove themselves from this risk.
Yeah, and this might just be, this conflict might just be the push. It needs to accelerate even quicker.
Exactly.
Daryl, thanks for coming in to break down, some of that report. It indeed is a comprehensive one, lots to cover. I appreciate your time. Daryl Ho, the Senior Investment Strategist at DBS Bank.